March 2020, as the world locked down and financial markets fell apart, gold dropped 17% in 2 weeks. Bitcoin fell 50%. Both were supposed to be safe havens. Both were supposed to protect you when everything else collapsed. Instead, they collapsed faster than the stock market. 4 years later, in 2024, a different story. Central banks bought more gold than any year in history. Bitcoin hit all-time highs. Governments began stockpiling both. But here's what nobody's asking. If gold and Bitcoin are both insurance against collapse, why do the people who understand money best treat them so differently? Why are central banks hoarding one and quietly watching the other? And what does that tell us about what's actually coming? This isn't a debate about technology versus tradition. It's a question about survival. When the next crisis hits, and it will, which asset actually protects you? The answer isn't what most people think. And to understand why, we need to go back to the moment when gold stopped being money and became something else entirely. August 15th, 1971. A Sunday evening. President Richard Nixon appears on television and announces that the United States will no longer convert dollars into gold. The announcement lasts 4 minutes. Most Americans don't understand what it means. Within a week, every currency on Earth has fundamentally changed. For decades, the global financial system rested on a promise. Foreign governments could exchange their dollars for gold at $35 per ounce. This wasn't symbolic. It was the anchor. It meant the dollar had to mean something. It meant America couldn't just print unlimited money. Every dollar in circulation was theoretically backed by gold sitting in vaults beneath Manhattan. But by 1971, there's a problem. America has been fighting the Vietnam War, funding social programs, running deficits, and other countries have noticed. France, under Charles de Gaulle, starts demanding gold for dollars. So does Switzerland. So does Germany. They're not trying to hurt America. They're just doing the math. And the math says America doesn't have enough gold to honor its promises. Nixon closes the gold window. Just like that, the link is severed. Currencies become purely fiat, backed by nothing except the promise of governments. Most people think this made gold irrelevant. They're wrong. It made gold dangerous to governments. Here's why. When money was tied to gold, governments couldn't inflate their way out of problems. They couldn't endlessly borrow. They couldn't quietly tax citizens through currency debasement. Gold imposed discipline. Once that discipline was gone, spending exploded, debt exploded, and gold became the thermometer that measured the fever. In 1971, gold was $35 per ounce. By 1980, it touched $800. That wasn't gold becoming more valuable. That was the dollar collapsing in slow motion. Gold didn't change. The measuring stick changed. And that's the first thing you need to understand about collapse insurance. It's not about what goes up. It's about what holds steady when everything else falls apart. Now let's talk about what gold actually is, not metaphorically. Physically. Gold doesn't corrode. It doesn't decay. It doesn't rust. A gold coin buried 2,000 years ago looks the same as one minted yesterday. That's not romance. That's chemistry. Gold is elementally stable. It's rare enough to have value but common enough to be divisible. It's dense, so a small amount carries substantial worth. You can't create it. You can't print it. You can't hack it. Every civilization that developed complex trade chose gold, not because of tradition, because of physics. Gold solved the fundamental problem of money. How do you store value across time without trusting anyone? You can't forge gold. You can't inflate its supply. You can't decree more of it into existence. This gave gold one critical feature. It was outside the system. Kings could debase silver coins. Emperors could clip currency. But they couldn't manufacture gold. So when governments failed, When currencies collapsed, when empires fell, gold remained. It didn't care about your politics. It didn't care about your laws. It simply existed, indifferent and incorruptible. But here's the complication. Gold requires physical possession to work as insurance. You can own paper claims on gold. You can own gold ETFs, gold futures, gold certificates. But in a real collapse, those are just promises. And promises break. The only gold that protects you is gold you control. That creates a logistical problem. Gold is heavy. It's difficult to transport. It's easy to confiscate. In 1933, the United States government made private gold ownership illegal and forced citizens to surrender it at artificially low prices. They called it economic policy. It was confiscation. So gold is both perfect and imperfect. Perfect as a store of value. Imperfect as a practical tool. It protects you from government failure, but only if the government doesn't know you have it. This tension has existed for thousands of years, until 15 years ago, when something new appeared. January 3rd, 2009. Someone using the name Satoshi Nakamoto mines the first Bitcoin block. Embedded in the code is a message: Chancellor on brink of second bailout for banks. The timing isn't coincidental. The global financial system is collapsing. Lehman Brothers has failed. Governments are printing trillions. Trust in institutions is evaporating. And into that chaos, Bitcoin arrives. Bitcoin is designed to be digital gold, fixed supply, 21 million coins, never more. No central authority, no government control. Mathematically scarce. But unlike gold, Bitcoin is weightless. You can memorize a 12-word phrase and carry $1 billion in your head. You can send it across borders instantly. No one can confiscate it if you store it properly. No one can inflate it. No one can stop it. The early believers called it freedom money. Libertarians, cryptographers, people who'd watched governments destroy currencies and wanted an alternative. But most people ignored it. Bitcoin was worth nothing. It was a curiosity. Digital nonsense. In 2010, someone paid 10,000 Bitcoins for 2 pizzas. At today's prices, that's over $900 million. At the time, it seemed like a joke. But something was happening beneath the surface. Bitcoin was proving it could work. Transactions were processing. The network was growing. No single entity controlled it. Governments couldn't shut it down. Banks couldn't stop it. And slowly, a new idea began spreading. What if you could have the properties of gold without the physical limitations? What if you could have collapse insurance that governments couldn't confiscate? By 2013, Bitcoin crossed $1,000. By 2017, $20,000. By 2021, $69,000. People called it a bubble, and they were right. But they missed the larger point. Bitcoin wasn't just rising in price, it was becoming institutionalized. Corporations started holding it. Hedge funds added it to portfolios. Countries began exploring it. El Salvador made it legal tender, and central banks, the same institutions that hoard gold, started paying attention. Here's where the story gets complicated. Bitcoin and gold are both supposed to protect you from the same thing, loss of faith in government money. But they don't behave the same way. In fact, they often behave opposite. When COVID hit in 2020, both collapsed, but gold recovered in months. Bitcoin took longer, then exploded higher. In 2022, when inflation surged and the Federal Reserve raised interest rates, gold stayed relatively flat. Bitcoin fell 70%. These aren't small differences. They suggest something fundamental. Gold and Bitcoin might both be insurance, but they're insuring against different kinds of collapse. Gold thrives in chaos, real chaos, wars, currency failures, sovereign debt crises. When institutions break down, people flee to gold because it's been money for 5,000 years. Central banks hold gold because in the final crisis, gold is the only asset other central banks will accept. It's the ultimate fallback. No counterparty risk, no dependency on technology, no need for electricity or internet. If civilization itself fractures, gold works. Bitcoin thrives in a different scenario. Not the collapse of civilization, but the collapse of trust. Bitcoin does best when people lose faith in central banks, but the system still functions. When inflation is high, but society is intact. When people fear their government will confiscate wealth, but the power grid stays on. Bitcoin is insurance against monetary mismanagement, not apocalypse. This creates a strategic divide. If you believe the next crisis will be controlled, a managed decline with high inflation and capital controls, Bitcoin makes sense. It's harder to seize, easier to move, more resistant to government interference. But if you believe the next crisis will be uncontrolled, a genuine breakdown in order, gold makes sense. It doesn't need infrastructure. It doesn't need consensus. It just is. The wealthy understand this instinctively. They hold both, not because they're hedging bets, but because they're preparing for different futures. Gold for total collapse, Bitcoin for authoritarian control, cash for short-term disruptions, real estate for stability. Diversification isn't about not knowing what will happen. It's about knowing that multiple things could happen. So let's talk about what's actually happening right now in 2026. Central banks are in an impossible position. Debt levels are higher than ever. Unfunded liabilities, Social Security, pensions, healthcare, these obligations dwarf current tax revenues. Governments can't cut spending without triggering social unrest. They can't raise taxes enough to cover the gap. That leaves one option: inflate. Inflation is a hidden tax. It erodes the value of money slowly enough that people don't riot. Wages rise, prices rise, but purchasing power declines. Debt becomes easier to service because it's repaid in devalued currency. This has been the playbook for decades. But there's a limit. Push inflation too high, and people lose faith in the currency entirely. We saw this in Weimar Germany, in Zimbabwe, in Venezuela. Once faith breaks, it's almost impossible to restore. Gold is rising because smart money sees this. Central banks are buying gold at record levels because they know. They know the game. They know the end game. Gold is their insurance against their own policies. It's not an investment. It's a lifeboat. When the International Monetary Fund holds gold, when China stockpiles gold, when Russia accumulates gold, they're not speculating. They're preparing. Bitcoin is rising for a different reason. It's rising because a generation of people no longer trust institutions. They watched the 2008 bailouts. They watched money printing. They watched inequality explode. And they concluded that the system is rigged. Bitcoin offers an exit, not from society, but from centralized control. You can't print Bitcoin. You can't bail out banks with Bitcoin. You can't hide inflation in Bitcoin. The code is transparent. The supply is fixed. Trust is replaced with mathematics. But here's the uncomfortable truth. Bitcoin's greatest strength is also its greatest vulnerability. It depends on the network. If the internet goes down, Bitcoin doesn't work. If governments decide to criminalize it, most people won't use it. If energy grids fail, mining stops. Bitcoin assumes the infrastructure of modern civilization continues. That's a big assumption. Gold assumes nothing. It exists whether the grid works or not, whether governments permit it or not, whether people believe in it or not. Gold is the pessimist's insurance. Bitcoin is the optimist's hedge. So which one is real collapse insurance? The answer depends on what you think is coming. If you believe we're headed for a slow erosion of purchasing power, rising authoritarianism, capital controls, and government overreach, but the lights stay on and the internet works. Bitcoin is powerful. It gives you freedom to move wealth, to opt out of inflation, to protect assets from confiscation. It's insurance against the soft collapse, the managed decline. If you believe we're headed for something harder, a real breakdown in trust, supply chain failures, bank runs, currency resets, sovereign defaults, then gold is essential. Because in that world, complexity is a liability. Technology is a dependency. And the oldest, simplest form of money becomes the most valuable. Most people won't experience either extreme. They'll experience something in between. Persistent inflation, periodic crises, bailouts, policy failures, slow decline. In that world, both gold and Bitcoin have a role. Gold as the anchor, Bitcoin as the escape hatch, gold as stability, Bitcoin as opportunity. But the real lesson isn't about which asset to choose. It's about what the choice reveals. The fact that people are asking this question, the fact that central banks are hoarding gold while corporations buy Bitcoin, the fact that trust in traditional finance is low enough that alternatives are surging, this tells you everything. We're living in the early stages of a monetary transition. The old system is straining. New systems are emerging. And nobody knows exactly how it resolves. History offers clues. Every time a reserve currency has failed, gold resurged. Every time a new technology has offered freedom from central control, authorities have fought it. But history doesn't repeat. It echoes. And the echo we're hearing now is unmistakable. People are scared. Not panicked, but uncertain. And uncertainty drives people toward insurance. Gold will never go to zero. It's been valuable for 5,000 years. It will be valuable in another 5,000. Bitcoin could go to zero. If quantum computing breaks its encryption, if governments coordinate a global ban, if a better technology replaces it, Bitcoin could vanish. That risk is real. But so is the upside. Gold will preserve wealth. Bitcoin could multiply it. The question isn't which is better. The question is what you're protecting against. Are you protecting against inflation? Against confiscation? Against collapse? Against irrelevance? Each risk requires a different strategy. And the people who survive the next crisis won't be the ones who picked the perfect asset. They'll be the ones who understood the risks and prepared accordingly. The real collapse insurance isn't an asset, it's knowledge. Understanding how money works, how governments operate, how power consolidates, how wealth is preserved across generations. Gold and Bitcoin are tools, but tools are useless without strategy. And strategy requires seeing the world clearly, without illusions. Central banks hold gold because they know. They know that promises break. They know that currencies fail. They know that in the final accounting, only tangible value survives. Bitcoin holders believe something different. They believe that decentralization is the future. That code is more trustworthy than institutions. That freedom requires opting out. Both might be right. Both might be wrong. Or both might be right at different times, in different ways. The future is uncertain. That's the only certainty. And in uncertain times, the best insurance is the ability to adapt. If you want to understand money beyond headlines and textbooks, consider subscribing.